Hi, this is Chapter 2, Part 2. In this chapter, we'll learn more about term life insurance, how premiums are calculated, what renewable means, and finally, why convertibility is such an important feature. Term insurance premiums. Term insurance is pure insurance. The premiums you pay are only for the death benefit. There's no cash value inside the policy. You pay for two things: mortality costs and expenses. I'll talk more about mortality costs on the next slide. Insurance companies have to pay many different types of expenses, like marketing, underwriting applications, paying commissions, paying death benefits, and so on. And don't forget, they have to make a profit too. Mortality costs. Each year, the insurance company calculates the mortality cost of the life insured, which goes up every year because the probability of death increases with age. In this example, a 30-year-old female has a term policy with a face amount of $100,000. Her probability of death at age 30 is 0.037%. So we calculate her mortality cost for this year is $37. Modal factor. Insurance premiums are paid in advance, annually. The premium you pay today is for the following 365 days. However, paying monthly is the most popular option, and insurance companies let you do that. To determine the monthly premium, you simply have to multiply the annual premium by the modal factor. Let's look at an example. Victor bought a term life policy with an annual premium of $1,000, but she wants to pay it monthly. So if the modal factor is 0.09, her monthly premiums will be 1,000 times 0.09, which comes to $90. And she's going to pay a bit more over the course of a year, because if you multiply 90 by 12 months, it ends up being $80 more than the annual premium. This is a page for selecting different types of insurance. You can see term insurance, you can see permanent, and you can see T100 here. And you can also select different types of insurance, including critical illness insurance. Now I want you to pay attention to two features here: renewable and convertible. Almost all term policies are renewable. That means at the end of a 10, 20, or 30-year term, the policy is renewed for another term with a higher premium. The reentry provision is a very popular exam question, so you have to pay attention. If a renewable term policy has the reentry provision, then when a new term begins, there are two possible premiums: a guaranteed renewal rate and a low rate if the life insurer can prove he's still in good health. For the exam, remember the initial premium is lower with the reentry provision. Here's an example. Let's put two policies side by side, one without reentry and the other with the reentry provision. Without reentry, you know in advance what the premium will be for the next term. So the first one here is the one without the reentry provision. After the first term of 10 years, you know how much you're going to pay every year for the second term. The second policy has the reentry provision. The initial premium is lower than the first one. But when the current term expires, you pay the guaranteed annual premium, which is higher than the first one, unless you can prove to the insurance company you're still in good health. So in that case, the renewal premium is lower than the first policy. The number one reason for getting term life insurance is affordability. It's just a lot cheaper than permanent insurance, at least in the initial terms. But you're also aware that term insurance expires, usually at age 85. And you also know that you cannot use term insurance for things like retirement planning or estate planning. Most term insurance, however, allow you to convert to some form of permanent insurance, whole life, UL, or T100. Proof of insurability is not required for the conversion. When you initially apply for term insurance, that's your original age. And when you decide to convert it to a permanent policy, the insurance company is going to use the attained age to calculate the new premium. For both ages, most insurance companies use the nearest birthday. But some companies use either the last birthday or the next birthday. After a policy is issued or reinstated, the insurance company only has 2 years to cancel a policy if it discovers any material mistakes in the original application. This is called a contestability period. And likewise, most insurance companies won't pay the death benefit if the policy is under 2 years and the death is caused by suicide. Now pay attention to this because it's a very popular exam question. When you convert a term policy to a permanent policy, the 2-year contestability and the suicide exclusion period do not get reset. It's treated as an extension of the original policy. And that's the end of this lesson.